So here we're going to move into the next learning objective for Chapter 14, Financial Analysis, the Big Picture. And this is where we start to see how did things change, what were those changes, and what do we do with this? There are three types of comparisons that really do improve the ability of the decision makers to make a decision based off financial information. There's intercompany. This is when we compare an item or a financial relationship within a company in the current year with the same item or relationship in prior years. There is intercompany, which compares the financial relationship of one company with the same relationship in one or more competing companies. And that is going to usually be for the same period, the same fiscal year, the same quarter, whatever you're looking at. And then there's our industry averages. And what that does is it looks at your financial information of your company and it compares that with that same item or that same type of a relationship in one or more competing companies. So industry averages are often published, or you can put together your own specific competitors that you want to look at and dial it to just specific competitors. There's a lot of different ways you can do this. Your investors are very interested in what is called your core or the sustainable earnings of a company. If you'll recall, sustainable income or sustainable earnings are those earnings that we expect to continue to have in the future periods. There are three basic tools in financial statement analysis. First being the horizontal, the second being the vertical, and the third being the ratio analysis. The horizontal analysis, which you may have also heard be called the trend analysis, is a technique for evaluating a series of financial statement data over a period of time to determine the increase or decrease that has taken place. You can express that increase or that decrease as an amount or a percentage, or in some cases, a company will show both. Here we have illustrated for you a horizontal analysis. Companies, when they provide their 10Ks or their annual reports, put in what are called comparative statements. So those will have multiple periods in them. Now, they don't actually show this increase or this decrease. So what you have to do as a user is you have to put this into a spreadsheet and calculate what that increase or that decrease is. How we do that is we take the most current year and we reduce it by the preceding year. So in this case, if you look, there was current assets of $2,717. We reduced that by the prior year of $2,427, and that tells us that the amount that we had as an increase is $290. We take that 290 and then divide it by that original or base year of 2,427. That's going to yield us a percentage increase of 11.9%. We do this for the entire balance sheet and we go all the way down. So that's exactly how they calculated this. If I had this in Excel, then I would say I would put in the formatting and then I would pull it straight down. Comparative balance sheets can illustrate a number of changes. So in the one we looked at before, current assets increased by $290,000 or 11.9%, as we discussed. The property assets increased by $174,000 or 6.2%. Other assets increased by $219,000 or 4%. And then the liabilities, you can see what those changes were here. Now we can do this for any of the various financial statements, including the income statement. Remember that we get these as comparative. Here we show the horizontal analysis of the condensed income statement. Done the same way. We take 2020's year, we reduce it by 2019. So in net sales, they increased by 869,000. That is an 8% increase. So we took the 869 divided by the 10,907, which gave us the 8%. What we then can do is, by looking at all of these changes, we can attribute what the increase in net income is. In this case, the net income increase can be attributed to the increase in the net sales and then a decrease in the income tax expense. The other type of analysis is a vertical analysis. This is also called common size analysis, and this is a technique in which we can express our financial statements, all of it, as a percentage of a base amount. The benefit of a vertical analysis is that it enables us to compare companies of different sizes. So when you look at financial statements, a lot of times you're seeing numbers in the millions. And yes, $1 million seems like a lot, but if you also have millions of expenses, then it's really not that much. So when we look at it from a percentage point, and we only compare those total percentages of those base amounts from one company to another, then we can really go apples to apples and say, okay, just sales. Doesn't matter whether it's 10 million or it's $10. How does that express back to your cost of goods sold, sales and administrative expenses, advertising, so on and so forth? On a balance sheet, most of the time we're going to express this as a percentage of total assets. Then on the income statement, we want to use something such as the net sales amount or total sales, depending upon how you're looking at the problem and how your company actually reports their amounts. So we take $2,717 in current assets. Here we have that for 2020. We divide it by the total assets of 11,397, and that gives us a percentage of 23.8. We then use the same relationship, the same base number of total assets for all of the accounts that are on the condensed balance sheet, and we do that for both years 2020 and 2019. Now, if we take everything out and we look, then we see that from 2019 to 2020, we increased our current assets pretty substantially compared to the increase in our property assets. Our current liabilities decreased as a percentage, as did our long-term liabilities. So we're carrying a little bit less debt. Common stock, and then retained earnings, and then what our treasury stock are as a relationship back to total assets. We notice that these are the changes that happened. There was a 22.6% increase, and then in 22.6% was the attributed relationship of current assets to total assets in 2019. Then in 2020, it increased to 23.8% of total assets. There's the decreases. We had some other assets change, what happened with our retained earnings, and how we had an effect on our total stockholders' equity, which increased from 19.3% to 22.1%. To illustrate this in the form of a condensed income statement, remember I told you you're going to either use total sales or net sales depending upon how it's reported. In this case, net sales is what we have. So we start with that and we say, what was cost of goods sold in 2020? It was $6,597. Divide that by the net sales of $11,776, and that gives us a 56%. We use the same base number all the way down for all of the 2020 figures. And then we attribute the same logic to 2019 using a base of net sales of 10,907. You can then side by side compare to determine how our performance in 2020 was compared to 2019. Remember, you can do this and compare your performance for your company year to year, period to period, your company to another company, your company to the industry averages, whatever there is available information publicly, depending upon the formation in your organization. Analysis of this income statement gave us changes of cost of goods sold as a percentage of net sales increasing. Selling and administrative expenses increased. Net income as a percentage of net sales increased. So see, just because there was an increase in things such as our cost of goods sold and our selling and administrative expenses, when it dropped down all the way, the increase in net income as a percentage of sales is really due to the decrease in the income tax expense. There were increases, but the biggest part of it comes back to that decrease in the income tax expense offsetting it. Here we have, again, the condensed income statement. You continue to provide that same logic. Net sales is your base amount. What is your cost of goods sold compared to your net sales? And we can do this, as I said, company to company. So in this case, we're comparing Chicago Cereal to Giant Mills. So Chicago Cereal's cost of goods sold is only 56%, whereas Giant Mills is 64.4%. So we continue to move down. We see, though, that for Chicago Cereal, they're selling and administrative expenses are 28.1%, whereas Giant Mills is only 19.4%. We follow this logic all the way down, and we see that Giant Mills, even with non-recurring gains and charges and other expenses and revenues, will yield 10.2% of their net sales to their net income compared to 9.4% for Chicago Cereal. So by eliminating the impact of the size difference, we can actually look at it more apples to apples. We lose that noise that comes down with the numbers. A lot of time, if we don't look at the dollars and we're looking at these ratio percentages or percentage of net sales, it allows us to focus on the performance versus the actual dollars. So I want you to go ahead and pause here real quick, and I want you to do the math, and I want you to compute using a horizontal analysis, assuming 2019 is the base year. And I want you to do the actual, just do a small Excel, so that way you can do the calculations and watch how they work. You can see that there is percentages of 30, 80, and 65 as increases in 2020 as compared to 2019. Now you can do this comparison 2020 to 2018, 2020 to 2017, if you wanted to see what the growth was from any period to this one. We're going to go ahead and end this particular lecture right here. We'll go into ratio analysis in the next lecture. Take a small break, read, look at the extra resources on both of these so that you at least know how they function and the information it gives you. then I want you to really start to think about, as an investor, a creditor, or manager, how does this information impact you? What does it tell you? Are you able to make better decisions? Or is it really just kind of a lot of noise for you?